Namaskar. Hello and welcome to PGurus channel. I'm your host Sri Iyer. Today we are going to look at markets episode 2 and 𝙒𝙖𝙪𝙤𝙦 is joining me, my co-host. And 𝙒𝙖𝙪𝙤, welcome to PGurus channel. Namaskaram sir, how are you?
Namaskara to everybody, and very happy evening to you all.
𝙒𝙖𝙪𝙤, we have been following this banking crisis closely. One of the things that strikes me is, have the banks stopped being banks, sir? One after the other, now we are hearing that after SVB, 186 banks could be in trouble. Most of them are regional banks. There's a flight of capital. That is essentially a panic trigger action after the fears expressed. Why somebody is trying to fan up the flames also? I just would like you to give us a 360-degree picture. What started, where things are now. We are also hearing that UBS and Credit Suisse might merge. What does that mean for depositors? Please take it away, sir.
Okay, I think that it's a great segue and great question to set the context. Well, we have had what we call free cash policy for almost now running close to 6-7 years. We have put trillions of dollars money into the system during this, almost, I would say, from pre-COVID days, going back to 2017, 2018. We have a tremendous amount of money that has flowed in, especially after 2019, when the interest rates came to zero, pretty close to zero, 25 basis points to zero. So there's a tremendous amount of cash that has come in. There's a tremendous amount of lending that took place into a variety of segments of the industry. All this cash flowed into the banking system. When the cash flowed into the banking system, then the banks took on the cash, recognizing in millions and millions of dollars, recognizing that only $250,000 per account is insured. To give you a perspective, as at end of 2022, United States has had pretty close to, I would say, $18 trillion of deposits, $18 trillion, of which $10.5 trillion is insured. So close to $7.5 trillion of FDIC has no insurance cover for that money. Okay, so this information is publicly available. When you kind of go to the FDIC website, you can see the historical view of the deposits covered by FDIC, the insurance reserve that is available to bail out any institution that goes under. This information is available, okay, publicly available, so everybody knew. What everybody did not know is one simple factor, which is namely, how have they deployed the deposits? Whether they're all deployed in long-term assets. Assets are illiquid. Long-term deposits, which is namely into bonds, into medium to long-term bonds, loans to entities, etc. So suddenly what has happened when there was a cash crunch in Silicon Valley Bank, some of the institutions wanted to withdraw their deposits. And they were withdrawing deposits in zillions of dollars. And on a Wednesday, SVB sold close to $20 billion to cover their positions because the clients were withdrawing at a $1.8 billion loss. Suddenly, the people within a very narrow ecosystem within California realized, okay, we got to take the money out. On Thursday, $48 billion of deposits left. When you have such flight of deposits is on the liability side of the balance sheet, then you have to offset it with assets. When you have no assets, you have to only liquidate the kind of the assets to make good the liabilities that you have. This mismatch has triggered, and this soon went into the other parts of the banking system, most notably the regional banks. Regional banks had anything from 40 to 50% of their deposits also in a SVB type a situation. So the panic struck in, which is to say, if you don't have risk management and fiduciary function, how come these institutions will have it? So it began to trickle down. This is what prompted, Sriji, all regional banks to send a letter to the Fed and the FDIC and the Treasury to state, please, all the deposits for a period of 2 years, doesn't matter whether it is 250,000 or higher, for the regional banks, all deposits, you please bring it under FDIC cover. That gives us the time window for us to manage the assets and liabilities and stabilize the system. If you don't do this, we are going to be managing this volatility on a daily basis, putting an enormous stress to the system. It's a long-winded answer to your simple question, what has led this trigger?
Sridharji, again, I'm talking like a common person who has deposit in the bank. I'm concerned. I'm saying that the interest rates went up from 0.25% to, say, now it's 5.25%. And it wasn't like a one big jump. It was a 0.5% at a time. So when it crossed 2, and the Fed was signaling that we are going to be raising the interest rates to fight inflation all along. So at some point, the danger should have gone off. Sridharji, I'm sorry to say this, but many of these people, the C-suite of bankers, these are all very educated, very eminently qualified Ivy Leaguers. How can you explain that? How did they not see this thing coming, sir?
There are many questions in one single question. So let me try to see whether I can pick up each of your questions. First and foremost question is, how come people didn't comprehend this? First, let me answer. That's very simple, which is to say, everybody should read the fine line. When you put more than $250,000 deposit, your deposit is not safe. That means you are taking a risk. Okay? So it very clearly says, as you said, I can have 1 account, 2 accounts, 3 accounts, each account to have $250,000. You keep it. Then you don't need to worry. You don't need to worry about, because if the bank goes under, FDIC gives you the money. So that's a very simple. But people have, say, no, let me put 500,000 because I got free cash. Let me put $1 million. I've got free cash. Mostly small businesses, which got tremendous amount of liquidity through various programs which you go into. So that's one side of the ledger. The second side of the ledger is, why many of the banks, when the investigations happen between Department of Justice and SEC, you will find either the risk management function was left vacant, or the risk management function was fairly abysmal. And there will be a mismatch between the deposits or the assets and the liability side of the ledger. This is what you're going to discover. And whether the boards really reported these numbers, people told me, oh, Basel III, Basel II, Basel I, all that is fine. I've been a banker for 45 years. I've done nothing but banking before I kind of retired. There are several things which are obvious, but those obvious things do not happen. When they do not happen, and when there is no reporting within the system appropriately, then it creates the systemic risk and the cascading effect in this situation. When you actually look at the balance sheet of all the banks overall, you will find either capital adequacy ratios or tier 1 capital or the reserve ratios or the loan loss ratios on the lending sector, you'll find there is no problem. The problem is in this mismatch. All the Ivy League intellects and super bankers or supreme bankers in some of the smaller institutions somehow failed across. Now, I'm not saying all of them failed. A lot of it has to do with animal spirits. When you have it's happening to a bank A, it's going to happen to my bank. My bank is of similar size. It's happening to bank B, or it's going to happen to my bank. So you do not find flight of deposits from the top tier bank. You don't see deposits going from Bank of America, JP Morgan, Bank of Citibank, Wells Fargo, and so on. You're seeing all this happening in the smaller banks because they're afraid, whether they are left exposed. It's not happening in Barclays. It's not happening in Lloyds. It's not happening in Deutsche Bank, but it's happening in Credit Suisse. It's not happening in BNP Paribas. So you find that this concentration is around the banks, where now they have discovered my deposit may be at risk, especially if I have more than $250,000. A lot of them are small businesses.
I'm trying to process what you said Sridharji. Now, I'm really again back to basics. how much money does the bank have as depositor money against which it lends money out? Like, for example, let us say the depositor's amount in bank A is $100 billion. How much does it actually lend out? In other words, the how much withdrawal at a time can it take?
It can take up to 5% of, 5 to 6% of the withdrawal is always kept in the liquidity situation, because most of the deposits have a duration. For example, money in checking accounts is not given for lending. The money which are in what we call long-term assets, is long-term deposits, is what is lent. Suppose somebody puts some money for 3 years. Suppose somebody invest capital for 5 years. That is lent. You have a long-term capital, you lend it for short-term. You don't take a short-term capital. That is, in other words, you don't take a 1-year deposit and take that money, and even if you put 30% of it, lend it for 5 years, you have no position to cover the 30% until that 5 years lapses and you have a distribution coming back to you. So this is what has happened. People felt that nobody is going to take the money back, and the interest rates were low, and then the interest rates went up. When the interest rates went up, they have to pay money on the deposits that they have raised. So the question therefore is, do you have liquidity, or your liquidity is illiquid? They were illiquid. They were in long-term duration bonds when people are saying, I need my money back. So what can they do? They have to terminate, foreclose, probably at loss. And when you do that, then you are beginning to reduce the size of the balance sheet, which puts, in simple terms. So this is to answer your question, which is effectively to say how much the bank lends. If you have money which is daily deposits, you do not lend anything against it. Very simple, because it can be taken today, it can be taken tomorrow, it can be taken, you do not. That is why most of them have 0% or 0.25% rates on the daily checking accounts. Whereas in the case of those which are long-term, make sure that you are lending it on a shorter duration and you have enough risk provisions. This is where the risk 1 capital comes in, or the tier 1 capital comes in. You have enough risk provisions and you report this risk provision so that the central bank can say you are adequately covered. This is what happens in large financial institutions, especially after the 2008-2009 crisis. This is constant and regular stress tests that have been done in the balance sheet of the bank. Even today, if you ask the question, just to give you the same numbers, on a $17 trillion deposit, there's only $12 trillion of loans that are given. 12 trillion has been given, to give you a sense of percentage. Okay, so there is a 60% maximum threshold or 55% maximum threshold in terms of loan to deposit ratio.
So this is the state of the banks of United States. Now let's take a look at what is happening between UBS and Credit Suisse. Both are Swiss-run banks. Both have been attracting money from all over the world, perhaps even from United States. Now there is rumors that perhaps the two will merge, or UBS will acquire Credit Suisse. Sridharji, when two banks merge, there will be a lot of overlap of function. Essentially, people will be let go. You don't need two marketing people, two sales people, two IT departments. I can go on. That is after the fact. But if there are two similar banks in a small country, how did one get so horribly wrong, sir?
Just the breaking news, Shriji, is UBS is going to buy, facilitated by the Swiss government and the Swiss Banking Corporation, somewhere north of $1 billion, which is $7 billion less than the market cap as of Friday, close of business Friday, the Credit Suisse. Okay. So in other words, this will be an outright buy. The Swiss government as well as the Swiss banking, they would not parcel off assets. They wanted UBS to buy Credit Suisse, and at a price that they're willing to both sides willing to agree. The contentious issue was around what you laid out or what you put out. So they said there's about 13,000 to 14,000 people who have to be laid off and I think we will get the details once the details of the merger are the acquisition. It's not a merger, it's a buyout. UBS is buying Credit Suisse. UBS is not merging with Credit Suisse. So UBS will buy outright for somewhere north of $1 billion all of the businesses of Credit Suisse. So there will be massive layoffs because there's a lot of overlap, as you rightly say. That's one part of it. There's already flight of deposits from Credit Suisse to UBS. That's been going on. Just to give you a perspective, between Q3 2022 to Q4 2022, Credit Suisse lost $100 billion of assets under management, and it could have only gone in the wealth management business, it could have only gone to Credit Suisse, UBS. So there has been, and the CEO of Credit Suisse has reported, there have been steady loss of deposits, $10 billion on an average per day. So therefore, this is very clear. Now, what is the other catalyst for this? The other catalyst for this is, we have the numbers that 2020 to 2022, when you look at the investment banking revenues of Credit Suisse, it's abysmal. It's abysmal. They refuse to accept that they are losing money in the investment bank, and they were given adequate kind of time. So the market as well as the clients did not accept the continued sustenance of the Credit Suisse business model. And today we are in a situation where UBS is forced to buy Credit Suisse.
Thank you, Sridharji. I know I'm kind of putting you in the spot here by asking you all these questions. Sir, you are a banker. That's why you are most qualified to answer some of these questions. None of the other anchors will ask these kinds of difficult questions. Thank you so much. Because, see, at the end of the day, a banker was somebody like your family doctor, your family astrologer, your family this, your family that. And now, suddenly, we are now beginning to have doubts whether this person really knows his job or is he doing his job. And that's where this crisis comes. So let's move forward. Usually in United States, when something like this happens, the rules will be tightened and they'll be over tightened. So what will happen is suddenly liquidity will dry up from the market. And that is death knell for industries which need that cash to grow. It's also death knell for startups. How do you see that part going, the overcorrection that is expected to happen?
Okay, there are three questions here. Okay, first question, is there liquidity? Yes, $160 billion, $130 billion of the Fed window through quantitative easing. They kind of loosened the rules and released the money. So people have been, using their assets and taking money and shoring up the balance sheet. So Fed has to that extent done the quantitative easing for a period of time rather than quantitative tightening. So that's the first answer. The second question, on a rising rates environment, under the present conditions, what's the outlook for credit? There is going to be credit squeeze. There's going to be credit squeeze. So all of the business ecosystem is going to be impacted, and we will get the GDP numbers in the second and the third quarter, seeing further contraction because there is no capitalization or there's no capital deployment for the businesses. So
viewers, we just lost Sridharji, but he'll be back. Please do like this video. I keep saying this thing like a broken record. The reason I keep saying that is because I'm asking some really difficult questions here of Sridharji, and he has been very, very patient with me. I don't ask one question, I'm asking 1, 2, 3 questions at a time, and he has been very patient. He has been answering all our questions, and he is rejoining again. Just stay with us. And also, if you have not already subscribed to our channel, do consider subscribing. We are also planning on doing more Twitter spaces, and that would mean that you would have to be a Twitter account holder. If you have not joined Twitter, I encourage you to join Twitter and follow @SriIyer1. Sridharji, I was going go ahead, sir. You are answering the question. 3 questions. You answered 1, I think.
Yeah, I answered 1, which is effectively there's credit squeeze. There's going to be credit squeeze, which is going to impact the business ecosystem. pushing us, if there was no recession, is going to push us, especially the markets in Europe and Asia, Europe and United States is going to be impacted. So that's number one, G. Number two is that
he has us hanging again on his answer. Unfortunately, the internet has again dropped. I think I can't hear him. I don't know if you all can hear him. Just bear with us while we get him back. Okay, so we have lost Sridharji. He'll come back. He'll rejoin, and like I said, do consider joining Twitter, and then you can be on Twitter Spaces, and also look for PGurus1. That is the other handle I would like you to follow. Sir, go ahead, sir. Answer number two.
Okay. The answer number two is that, which is effectively the rate increases will have direct bearing on the cost of capital. So there's only going to be discretionary spending that's going to happen. So which means it's going to further shrink. The third is this will cascade itself into consumer credit as well, and there will be tightening on consumer credit. So you're going to see both on the demand side as well as the supply side, cash being stopped, economy going into a deep spindle. What is the consequence? The consequence is trouble ahead in the European and the US markets. I think I don't think Fed wanted a recession, but the rapid acceleration, in the next program we'll show the chart. When you see the rapid acceleration of the interest rates that has happened in a short a span of time, most of the institutions have not had, especially the smaller institutions, have not had the ability to manage the two sides or the three sides of the balance sheet. That is why they go to the market, raise capital. There's no capital. And this is what is going to impact as a result of the tightening of the quantitative easing or quantitative tightening and the rapid rise in interest rates. And fortunately, Asia seems to be weathering this storm, but how long remains to be seen, because most of them are tied to the Fed rates. So you can see some cascading effect of this flowing on into Asia as well.
Thank you so much, Sridharji. And now we're going to take some questions. I mean, we can go around and beat this thing again and again. It's kind of obvious that recession, if it was not already there, is definitely upon us now. And we have to just be sure, be sensible about how you bank. Like Sridharji said, have multiple bank accounts. Make sure that kind of spreads your risk a little bit. Perhaps different banks, that's another option. Now, if you try to onboard, you're going to have some delays because everybody is rushing towards some of the more stable banks. So that is another concern. We'll have to wait and see. Let's take some questions. Somdev Das wants to know, how much interest rate will Fed raise this time in the March 21st, 23rd meeting?
If I have to predict, my vote is for 0% increase, but many believe it will be a very short 25 basis points increase. And I'm not betting.
Unfortunately, we have lost Sridharji again, and he'll come back. So, Somdev, I hope you got your answer. Sridharji predicts either 0% or 0.25%. I think they will not do 0.25. Right now, if they do that, that would be a very negative sentiment, and they'll have to wait. The interesting thing that I have is the Fed is supposed to be very good at modeling all these things, using software to understand the cause and effect. So how did they miss this one? Of course, they were telegraphing that the interest rates are going to go up, 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 and up. So what?
So can I just use audio?
Yeah. Please do, sir. Please do, sir. Try audio only. So Sridharji is on audio. Next question, please. I think we missed the previous one. Can we go back to the previous one? Oh, okay, that's the next one. All right. Raghunandan wants to know, India post-deposit is much better than Silicon Valley Bank. Sir, your view on it. Sridharji? Unfortunately, we have lost him again. So as I was saying, consider joining on Twitter. He's back. Sridharji, can you hear us?
Yeah, I can hear you now. Yeah.
So you can see the question, sir. India seems to be doing better than Silicon Valley Bank. Your thoughts. Sridharji, unfortunately, I think we are still having connectivity issues.
Let me
We may
try
have to
whether I can
stop.
come on my.
Yeah. Yes, sir. On your phone. We are trying to see if Sridharji can come on the phone. He was on his laptop. These connectivity issues can sometimes be really frustrating. Just wait for a moment and he'll come back. We have one or two unanswered questions. We will pick up those questions. And in fact, if you've been following one banker, Balaji Srinivasan, Balaji S is a Twitter handle. Twitter is where most of the action is, by the way, guys, on banking. So Sridharji, go ahead and answer the question, sir. Are Indian banks better?
Indian banks are. I mean, I cannot say. I don't have data on the imbalance between what is insured, what is not insured in India. I think you have to go to the data to respond to the question. So I don't think I have that data. But as you can see, one of the Indian ministers went public and said that the Indian banking is far more stabilized. It's not that the US banking is unstable, but there is a heavy concentration of deposits, and the fear psychosis is what is driving. When you actually look at, one of the days we'll give you the FDIC full data. When you actually look at the data is not sounding alarming. But when you have animal spirits, when you have rapid flow of deposits out, banks will not be able to, no institution will be able to manage the asset liability mismatch. No institution. And this is only happening. You're not having run-up deposits in JP Morgan. You don't have run-up deposits in Citibank. You don't have run-up deposits in Bank of... The large institutions are managed, and that is where the money is going to. The fear is whether the smaller banks, what are they going to do with these uninsured deposits, especially if the Fed and the FDIC is not supporting them. This is what is driving the fear, Sriji.
Thank you, sir. Next question, please. CA Vishwanathan wants to know, please explain if this is an attempt to clean up small banks to enable the CBDC central bank digital currency. Sridharji, are you there?
No, I'm here. I don't think this has anything to do with the digital currency. So digital currency is much more around efficiency of the payment system. It has got nothing to do with the asset liability kind of mismatch. So therefore, the asset liability mismatch has to be managed in a far more fiduciary manner with a chief risk officer dedicated. Doesn't matter what the institution is. When the investigations come out, you will find in SVB, for 9 months, there was no chief risk officer. 9 months. So what happened to all the capital coming in? We will know when the investigations reveal. I repeat, 9 months, SVB had no chief risk officer.
Next question, please. Rajan TRS1 wants to know, how many banks have links to Democrats like Silicon Valley Bank?
Many. Big, small, and medium. Many.
So I'm going to ask the obvious question. Have Democrats started thinking that banks are their own personal ATMs?
I don't know. This is a difficult question to answer, unless you want, you are in public television. So, what can I say? I think that all I can say is that I don't think the Democrats are looking at it as a personal ATM, but it is corporate America drove itself into a woke agenda. Again, when investigations come out, you'll find SVB had no chief risk officer. This is public information, but they had chief diversity and inclusive officer whose focus was managing diversity within SVB. So you ask me a question. This all will be Ivy League and Harvard and Stanford and, super intelligent people, Sriji. So there you find the answer to your probable question. Now, each of the banks, you'll find some sort of issues like that.
Thank you, sir. Next question. Darshan wants to know, what is outlook on the US debt defaults? Sridharji, are you there? Viewers, unfortunately, we are having some connection issues today, and I think we're going to wait for a minute to see if he can rejoin. If not, we'll have to stop here. Thank you so much for all your questions. Let's see, just wait for a second. Usually it reconnects. I'm seeing on my panel that he's trying to reconnect. Just wait for a few moments and let's see if he's able to establish reconnection. We're trying multiple devices also to try and see if that would improve connectivity, and it's sometimes challenging. So just wait with us, just bear with us for a second, and then we will say if we want to continue or we want to stop here. Unfortunately, I still don't see Sridharji back. Please like, share, and subscribe to our channel. Don't forget to click on the bell button for notifications. Sridharji has just returned. Sridharji, the last question was, what happens to US debt defaults?
Oh my God.
Can you see the question, sir? I think we are going to, we're going to stop now because it's getting difficult to reconnect. One last time we will try, and if it doesn't work, we will disconnect this program and end it at this point. You got the gist of it. You know that there are some systemic issues here. Unfortunately, herd mentality is overpowering many people's thinking capabilities, in my opinion. Thank you very much. Namaskar.